let's just go to Kelvin Emmanuel. Let's go to Kelvin Emmanuel sitting in our Abuja studios right now. Kelvin, good evening to you, sir. What a time to be alive, Kelvin. Oh my goodness. So, Kelvin, take it away. $60 a barrel. What does that mean? What does it mean, Kelvin?
It's so good to see you. Good evening to you. Yeah, so it's interesting because a few months ago, I think it was either in late January or February, when the Appropriation Act was approved by Parliament, I'd mentioned that $75 oil price benchmark was a bit optimistic, considering that the Nigerian government knew that Donald Trump had won an election, and his Treasury Secretary had proposed a path for America. Now, if the government had done what they call cash flow modeling, if the Nigerian government, the Federal Ministry of Finance, in collaboration with Federal Internal Revenue Service and NNPC, if they had sat down in a meeting and they had done what they call cash flow modeling, they would have been able to see what they call the cash waterfall, cash cascading, and do a simulation of their cash flow at different price levels. And they say, okay, at $100, this is what we're expecting, less the encumbrances at 90, 80, 70, and then below the red line, this is what we're expecting. Then these are all the obligations we have: joint venture cash calls, forward sale agreements. And considering that, Rotus, if you look at all the forward sale agreements that the government currently has, the ones they structured from 2019, the ones they've paid off, the ones that are still existing, and the new ones that they've structured, Project Leopard, $2 billion. Repayment is until 2029. And then Gazelle 2, which the details are not out yet, $7.5 billion. Repayment is till 2034. You see that so far, for the ones that is structured, last of which was early last year, Project Gazelle 1 of $3.4 billion, only Gazelle 1 actually has what they call a debt service reserve account that is supposed to be like a downside balancing account in case the price of crude drops below the strike price of $57, which was where the price at which they had capped it. Okay? All the other forward sale agreements that is structured, none of them had a debt service reserve account to act as like a stabilizer in case crude oil price drop below the strike price. So this is a failure of the fact that today, Rotus, as we speak, the Central Bank of Nigeria, the Federal Ministry of Finance, Federal Internal Revenue Service, none of them has what they call a hydrocarbon accounting framework that helps you to see compliance, transparency, balance, and allocation, material balance and allocation for the entire crude oil supply chain upstream. None of them has, what they take, Rotus, is what the NNPC gives to them. So if NNPC comes and says, okay, today we did 1.5 or 1.47 or 1.45, that's what they take. There is no independent structure that the government has developed that is used to independently assess and audit what is brought to subsurface, what is allocated to partners, joint venture partners, and then what actually comes to the government after encumbrances. So the fact that you don't have a cash flow modeling structure is the reason why the government was not able to predict or plan that a day like this will come when crude oil prices drop below $60 a barrel and when the 2025 oil benchmark price will be in jeopardy.
Well, Kelvin, even if you could plan a scenario to where you see $60 a barrel, what do? This is literally what? Okay, oil contribution to GDP is what? 5%. Non-oil is 95%. But the FX contribution of oil is what? 7%. So even if you had your cash flow modeling, and even if you could see that you could have Trump, I mean, I don't know who had a crystal ball to know that Trump is going to come into office and demand $50 oil and tell OPEC to drop oil prices and say drill. Even if you could see it, Kelvin, what do you do to mitigate against that? This is literally the only thing that we have that brings in foreign exchange. So and it's not just Nigeria facing this. Iran is facing this. Russia is facing this. Saudi Arabia. I mean, mention any OPEC plus country that is a major oil producer. They're all facing the same thing. So what could Nigeria have done?
So, Rotus, Nigeria has one of the highest unit production cost per barrel. Okay, and so many factors go into it. Number one, Rotus, I'll tell you that categorically, Nigeria does not actually know how much crude oil comes to subsurface. And that's because it doesn't have a wellhead metering system or a SCADA in the upstream supply chain that helps you to measure, number one. Number two, the estimated ultimate recovery that gives you what, the operators are expecting, and the integrity of the supply of crude from the wellheads to the flow stations to the terminals. There is no integrity in that chain, okay? That contributes to unit cost of production because some of the operators have to rely on barges, which are alternative crude oil evacuation routes to be able to take crude, avoid vandalization and bunkering and all of that happens. Okay. Number three, the cost of contracting, right? All of this, when you look at it and when you put it into like your petroleum fiscal regime modeling structure, you see why the unit cost of production is high. It's the work of the government to do the heavy lifting and deleverage the factors that contribute to having a high unit cost of production. In Saudi Arabia, unit cost of production is anywhere between $9 and $12 a barrel. So even if crude oil price drops below $50 to $40, the Saudi government will not be crying as much as Nigeria is crying. In Iraq, in Iran, in those countries in the Middle East, unit cost of production is not above $15 a barrel. Even in Libya, that does not have a central government, that I hear is currently doing 1.3 million barrels per day, unit cost of production is not up to $20. So why is the unit cost of production in Nigeria trading anywhere between maybe $36 and $48 per barrel? That's the range. I think FRS has their own benchmark at about $36 a barrel, if I'm not mistaken. The other arms of government have their own benchmark at anywhere between $45 and $48 per barrel. So one way for you to be able to cushion the effect of lower oil prices, which you don't have control over, because Nigeria is the 12th largest producer, right? And Nigeria has 38 billion barrels in proven reserves, but it's doing only about 1.47 million barrels per day. Right? The way to manage it is to ensure that your unit cost of production per barrel is low, which is in the norms in other oil-producing countries.
Gotcha. Point well made. For the average Nigerian watching this now, crude oil prices, again, they've been trending downwards. So talk about the impact on the people who go to buy fuel at the station. This should mean lower prices at the pump. And we've seen the Dangote refinery cutting prices, about 3 times. I think NNPC also cutting prices. Have they essentially been taking advantage of lower crude oil price? I know the exchange rate plays a role. Crude oil prices take a role. But yeah, I guess there's 2 sides to this coin, right, Kelvin? But Nigerians should expect lower pump prices, yes. But also the budget suffers, right? Can you talk about that the 2 sides to that coin?
Well, the budget suffers. The budget suffers, and you not being able to have enough FX to do your balance of payment, and the CBN meet up its obligations, basically means that it's going to be difficult for the CBN to ensure that the exchange rate stays at where it is. Where it says it's aim with stability. The CBN came out with a press statement and said it's if the Nigerian foreign external reserves is at $23.1 billion, which even if I question that, because if your net reserves that is unencumbered is at 23.1 billion, and JP Morgan is talking about quality of reserves and saying your short-term, medium-term foreign liability obligations has not been disclosed, in details, then how are you not able to meet up with your obligations, and how are you able to rely on forward sale agreements to be able to get FX to meet up with your 3 to 6 months obligations on Eurobond payments, IMF dues, and FX forwards that remain of about $3.2 billion. Now, Rotus, back to the question about the impact of crude oil prices and petroleum pump price, okay? The refiners have what they call cracking margins or crack spread. So it basically says that they are able to hedge, and if they hedge futures for higher crude oil prices, and crude oil prices comes lower than their benchmark, and their refining volume gives them more value than the cost of their hedge, then they are positive. So lower crude oil prices basically indicates that they have positive cracking margins and they can adjust their price. But then there's an issue of transfer pricing. So if, for example, Dangote paid for crude a month ago and crude oil prices are only now dropping, how far can the market sustain the low crude oil prices for him to be able to transfer crude he bought at highs to lower prices in the market? Now, that's where the futures market come in. You have all instruments like what they call dated Brents that refiners use all around the world to hedge the impact of all of these adjustments. If crude oil prices stay under $65 a barrel, I expect that in the coming weeks, you see that based on the Platts system of calculating the pump price of PMS, which is basically when you multiply the price of a metric ton of petrol times 1,341 liters divided by the exchange rate, you might see like an impact of reduction in the recommended retail price of PMS across pump stations in Nigeria, right? But the other side to it, of course, like you indicated earlier, is the exchange rate. So if, for example, the price of crude is coming down and the naira is dropping, how do you balance that?
Gotcha. Good point there. But your point is well made. Those two competing factors. One more question for you, Kelvin. We've got Goldman Sachs saying, with a new forecast, saying that oil prices could drop to about $58 a barrel by the end of this year. Okay, I think I got some more time. I've managed to squeeze more time from our producers to keep you on the show. So this is not my last question. There'll be further questions. What do you make of their forecast that oil prices could stay lower I think it's by the end of 2026. So they're forecasting lower oil. Are you in line with that, with the way the dynamics seem to be working, geopolitical and the like, and also the fundamentals?
So I think that the impact of the tariff, even if the US government has promised to exempt oil and gas, and then the Chinese government says that no, they are slamming a 34% tariff on US LNG. US currently controls 26% of the global LNG markets. The impact of that, of the fact that if crude oil price drops below the shale unit production cost benchmark in America, because shale is more difficult to produce and the unit cost of production is higher, it's going to force a lot of operators in the US to scale back. If they scale back, it will affect LNG, because a lot of those LNG are methane gas that they separate and then they liquefy at minus 168 degrees. So if they scale back crude oil production, it will affect associated gas and it will affect their LNG output. So basically, you have a market where there is a threat of glut. If you look at the forward curve, you see that there's likelihood of Russia is coming back to the markets. There is tariff affecting the impact of people willing to take products. Crude, because of the effect of the tariff on the price of the product and their profitability when they refine, their cracking margins when they refine. You see that dated Brent futures are indicating stops at anywhere around $45 a barrel. And that is going to definitely impact on, because if you have puts future contracts, which are sell future contracts, and they've placed like their strike price of around $45 to $40, then you definitely see that there are further downsides in this market. And we might see, we will not see a repeat of what happened in COVID when we had negative crude oil prices. We might not see crude oil get to $35 or $40, but we might see it touch $50, around $50, $55 a barrel. And that would not be good for either the budget benchmark in Nigeria, neither will it be good for the wholesale strike price that Nigeria has for the debts that it owes creditors.
So does that then, are we talking global recession? Because I know JP Morgan and the same Goldman Sachs are both raising their forecasts of not only a US recession. I think JP Morgan was 60%, Goldman was 45%. If a number, you said COVID is a good example. There was also what happened in 2015 when the Buhari administration was just coming in. Basically, the last two recessions we faced in Nigeria have been on the back of oil prices dropping, although, as you've already said, it's not to that degree. But if other countries around the world You've mentioned, the benchmark for refiners to stay in business for operating costs and the like. If we're getting to $50 per barrel and so on, are there not repercussions for the global economy as we see it?
There are repercussions. And you see, one of the threats of tariff is that if tariff is making it not economically viable to move crude oil feedstock around the world, what happens is that there is production and then there is a glut of supply. When crude oil comes to subsurface and it gets to terminal and there are not enough terminals to accommodate it like you had in COVID, there was a lockdown and there was not enough throughput to accommodate the supply, and then there was a glut and crude oil prices just tumbled. This will be the impact. So if the WTO does not step in, like the US government is not willing to listen to the WTO and all these multilateral trade structures that has been set up for decades, it wants to create a new system according to it. If the WTO is not allowed to step in to calm heads down and resolve this conflict very soon, what you're going to see is that the tariff will create like an impediment to global supply chain for crude oil, and that will impact on the throughput capacity that you have in producing countries to be able to hold what comes to subsurface on a daily basis. Since for most of those rigs and structures you have surface producing units, you can't shut it down just like that.
Wow. Well, Kelvin, it's a really... Go ahead.
Definitely, Rotus, I see crude oil prices, to steady at around $50 to $55 a barrel. I don't think you see $40 oil this year, to steady around that range. But you shouldn't expect $80 to $100 oil prices until at least the fourth quarter of the year, or maybe there is a geopolitical conflict. Maybe China invades Taiwan, like there are rumors that something might happen, or that there's another war that breaks out in the Middle East. But if we have the current trade realities as we have today, I definitely see crude oil prices steadying at around $50 to $55 per barrel, and it not going above $70 until at least Q4 of 2025.
Wow. Okay. Well, I guess final question, and that means Nigeria has to borrow more. We have to make up that gap from where the budget is to where your projection of 50-55, which is about a $20-something difference. We got to borrow more, and we have to fill that gap because we're not going to get the revenues we expected from a benchmark of 75. So your final thoughts on what that means for Nigeria until the fourth quarter of this year then?
Rotus, to be honest with you, when you say that Nigeria has to borrow more, I'm just wondering what's the leverage they have to actually borrow more. My best guess is for Bayo Ajulare. He's taking on a very difficult job. For him to send NNPC to an IPO, it will take him time. It will take him at least 15 months if he's very quick. But the Ministry of Finance has developed like a hydrocarbon accounting framework for them to meter and fiscalize the entire supply chain upstream, do a complete business process for engineering of NNPC, take off dead assets. He needs to check do an evaluation and classification of all the existing and new wells, the reservoirs that they have, to determine the estimated ultimate recovery they have for newly producing wells and aging wells that have reached maturity and is reaching its peak. So that they can go and determine what they call the net asset value of their assets upstream. Because when you're doing an IPO, for example, which is a way for them to raise money for not just themselves or for Nigeria, there are three basic ways that they do these valuations. There is the company comparison model. There is the net asset value model, and then there's a discounted cash flow model. So they'll use the discounted cash flow for the 2P and 3P reserves. Then they will use the net asset value for the existing wells that has the reservoirs, and to determine the net less the contingent liabilities that they have. The quickest way for them to get out of this quagmire is not by going to borrow more loans from the IMF or the World Bank. Even if at some point IMF might need to come and temporarily step in. The quickest way is to turn around NNPC. NNPC is the cash cow.
Gotcha.
NNPC is the foundation of the Nigerian economy, Rotus.
Kelvin Emmanuel, always a pleasure having you on the show. $50, $55 a barrel for oil 2025. Very interesting times. Thanks for giving us your insights. I really, really appreciate it. All right.